Hello, everybody, and welcome. We are glad that you're here. My name is Jordan Dechtman, and joining me on today's video is Sam Dechtman. We are both wealth advisors with Dechtman Wealth Management, and today we're going to share with you financial insights with regard to what's going on currently. This next slide is our standard disclosures. You've seen that before. And now let's jump right into the agenda. So we're going to touch on all these areas in order: economic update, tax strategies, long-term investing principles, and we're going to get into specifics regarding a Roth IRA conversion as well as a cash plus strategy. So with regard to the economic update, in fact, the Senate just passed a stimulus package for small businesses. This has recently gone into effect after the very large $2 trillion stimulus package was passed just recently. The good news is parts of the U.S. are starting to open, and hopefully by the end of April into early May, we're going to start to see this slowly progress. What's created a lot of volatility lately is oil. The good news is that a gallon of gas costs less than $2 in Colorado. I just recently filled up my car and it was $1.50. That's a positive thing, but it has created some uncertainty economically speaking. More importantly, the energy sector represents less than 3% of the S&P 500. So we don't see that as an overriding factor, but it's something at least we're watching very closely.
Great. Now let's get into some tax strategies. Some of these were created by the first gigantic government stimulus package, and others have been presented to us through different changes in the market and the economy. So first tax strategy is to stop your RMDs for 2020 if you don't need the money for income. So with the CARES Act, which was that latest government stimulus package, they said for 2020 that you are able to waive your RMD. Now this applies for your IRA, and this also applies for an inherited IRA. So if you don't need either of these, we can go ahead and waive them for 2020, and that will help save you on your tax bill. And even if you still need the income, maybe we decide to take it out of another account that you have as opposed to your IRA to, again, help with that tax burden. Second tax strategy is potentially looking at doing some tax loss harvesting. So what this is saying is while some investments are down, you can look and to see if some positions are worth moving away from and capturing that tax benefit at the moment. So if you sell something and it has a capital loss, that is offset in the future versus capital gains. So again, if there's some investments that have been struggling, now could be a good time to move on and look for different opportunities. A third tax strategy worth taking a look at is diversifying large stock positions. Many of our clients have either inherited stock options, maybe from their parents, or they, throughout their careers, have worked for companies and have had very large positions. And now, given that the market has come down a little bit, might be a good time to think about diversifying, because the main reason why they were not diversifying previously was because of large taxes that may have been a part of the decision to just hold. But now we're presented with an opportunity to maybe start moving away in some positions like that. And then lastly, to coordinate and consolidate. So we're also told by our clients that maybe they have an old 401k they forgot about, or an other account here or there. And it's really important to make sure that all of your investments are coordinated and consolidated. So when you're preparing your tax return for 2021, that you really have all your investments in one place, so you don't have 1099s, 1099Rs, and really make sure that you have a coordinated strategy. And one other thing just wanted to point out to make sure everyone was aware of is that if you are going to receive the government stimulus check, and some of them have already been distributed, it is not considered taxable income. So if you haven't received your government stimulus check and you know that you should be getting one, I would be on the lookout for that in the next few weeks here. But again, the check you receive based on the government stimulus package is not taxable.
Sam, you bring up a good point just on the government stimulus check. If you haven't gotten your stimulus check yet and you wanted to check on the status, you can go to the IRS website, irs.gov, and you can track your stimulus check. And they've already begun sending out those checks. Some of you already received it, others are still waiting. So that's another way for you to just get an update.
Thank you. And one thing we wanted to highlight, this is something that we are saying all the time, but wanted to give you more numbers. I'm a visual person. I know Jordan's a visual person, and I'm sure many of you out there are visual people. So we wanted to really illustrate one of the timeliest investing principles there is, and that it's don't try to time the market. So what we're looking at here is a slide, and it shows the hypothetical growth of $1,000 invested in U.S. stocks in 1970. Now, starting from the top to the bottom, if you had invested that $1,000 in U.S. stocks in 1970 and just left it in the market, the portfolio would have grown to 121,353. By missing just the best performing day over a period of 50 years, your portfolio would have been down to only 108,758. And by missing the best 5 days over a 50-year period, you can see that the results are even worse, going all the way down to missing the best 25 days. So what we're trying to say, and what this slide is trying to illustrate, is that no one, including us, has a perfect crystal ball where we know where the best days or the worst days are going to happen. But what's important is that we do remain invested or close to fully invested at all times. Now, that doesn't necessarily mean that you have to keep the asset allocation static between the amount of stocks and the amount of bonds that you have in the portfolio, but generally speaking, in most cases, we try and steer investors away from just selling and going to cash, because again, you can see historically that the effects can be pretty detrimental by making very emotional decisions. So now we're going to get a little bit more of an explanation to a Roth IRA conversion. We've talked about it in multiple videos. We've talked about it in our in-person meetings, but we've gotten some feedback that maybe would help to go into a deeper explanation as to what a Roth IRA conversion is. And then on the next slide, we're going to discuss the benefits on why a Roth IRA conversion could be beneficial to you. So how does it work? What you do is you transfer money, or you roll over money from a 401k, traditional IRA, or other retirement plan that you're putting pre-tax assets into, and you roll that over or convert it into a Roth IRA. Now, when you convert the monies from a traditional IRA, you will owe taxes on the amount of the pre-tax assets you convert. And you can either choose to do a partial or a full conversion of the assets into a Roth IRA, so it's not an all or nothing type of a deal. So an example is, Mary has $100,000 in a traditional IRA, and she converts $50,000 to a Roth IRA in 2020. So $50,000 would then be considered taxable income in 2020. Now, it's very important to do the research and do the numbers, because the increase in income could affect Medicare premiums. It could also affect the amount of Social Security benefits that become taxable. So why would you want to do a Roth IRA conversion? What are the benefits of a Roth IRA? So while the tax is paid on the conversion now, when you go to take distributions out in the future after age 59 and a half, those distributions will be tax-free. And so a few of the benefits that I was hitting out before in terms of having money come out of a Roth IRA later in your retirement years versus a traditional IRA. So you can see that by the money coming out of a Roth IRA in later years, you could have lower income from a tax perspective, which means lower taxes, could potentially mean lower Medicare premiums, and it could also mean potentially less of your Social Security benefits are taxed. So down here at the bottom, you could see the example again, choosing Mary. So Mary, again, is the $50,000 here in the traditional IRA, and she has the $50,000 in the Roth IRA. So anytime Mary pulls money out of a traditional IRA, all of the distribution is taxed unless, of course, money is being sent directly to a charity through a QCD. Whereas with the Roth IRA, the money continues to grow tax-free over her entire lifetime, and anytime she wants to pull money out, it's completely tax-free at that standpoint. So Roth IRAs don't make sense for everyone, again, for the different tax implications now and having the money in order to doing that, but putting together a strategy is definitely something that we think is worth considering now, especially when the market is down from its previous highs. Jordan?
Okay, thank you, Sam. Keeping me on track. So this is another strategy that's really taken a lot of traction, and we refer to it as the cash plus strategy. So in other words, a lot of questions we've had lately is what to do with cash now. We know that bank accounts, CDs, hardly pay anything at all. But the idea here is that with this cash plus strategy, it's another option. It's an alternative to leaving money in the bank. So exactly what it is, it's 100% fixed income in bonds, and the portfolio is a diversified strategy that encompasses U.S. Treasury bonds, governmental agency bonds, high quality corporate bonds, and if it is a non-retirement account, tax-free municipal bonds. This potentially provides a much better return than just leaving money in a regular savings account or a CD with minimal risk. Importantly, it is liquid, it is accessible, you can add to this, you can draw from it as needed when needed. If this is something of interest to you, please give us a call, let us know, and we'd be happy to walk you through a more detailed discussion. And lastly, we're here to help. This has been a very challenging time for all of us. Should your family or friends have questions and you think we can help them, have them give us a call. As you know, we're never too busy for you. We're never too busy for those that you care about. You see our phone number, 303-741-9772. If we haven't chatted in a while, we are here for you always. We're in the office. We're here working not only every day, but overtime. And we want you to know how much we care and how much we appreciate you very much. On that note, we want to say thank you for joining us on the program today. And again, feel free to reach out with us with any questions or concerns. Have a wonderful day. Thank you.